Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Let's talk about money market rates right now. Let's start off with that. And what I want to emphasize is that when you're putting money into a savings account, a money market account, a checking account that pays interest if you can find one, just something along the lines of that's generally deemed risk-free or based on something that's either FDIC insured or some type of a very lower risk fixed income product as such. And I'm just going out on a limb and guessing that you can get 1%, and maybe you can get that, maybe you're not able to. It depends on what you're looking at. But my point is this: are you really getting 1%? Let's say just theoretically you're putting 100% of everything that you own into this magic money market account that's FDIC insured, let's say, and it's paying 1%. Well, what if the US dollar goes down more than 1%? Well, in another country, you're going to be losing money. Let's say that you lived in Italy or you live in England or whatever the case may be, and you had your same money in that same account. You'd actually be down money in an account that's actually supposed to be a safe account and not lose you any money. Now, with that, if you understand how currencies work, you get that, and you kind of have an idea of how that can be the case and how currencies play a role with everything. But let's say that we want to have the isolationist mentality saying, okay, I never go overseas, I never travel anywhere. Why on earth do I have to care? I buy all my stuff in the U.S. How does that affect me, Mike? Well, here's some things with which to think about. A lot of things with which you buy are imported. Right now, I'm talking to you on a computer that was not made in the United States. A lot of you buy cars that were not made in the United States. A lot of you buy things that are imported. So with that being said, currency actually plays a role in that because of the fact that whether you want to admit it or not, you're an international currency trader just by purchasing pretty much anything. Now, let's say that you buy all American stuff. You buy American cars, you buy American clothes, you buy American appliances, whatever the case may be. It's very likely that at least some portion of the American-made thing that you buy bought some type of part from somewhere overseas. So with that in mind, my point is that things that are overseas do have an effect on you. Now, the other thing that you need to take into effect, what about the cost of things that are exported? So let's say, for example, that the dollar becomes very, very weak. Well, if that's the case, then someone from overseas can buy more of my product in the U.S. because the dollar's so weak. And to him, it just got a lot cheaper. To me, I'm making more money, and I'm happy that way. So it's one of the ones to where it may work well for you, it may not. It's something with which you need to factor in. So it's the third bullet point that I want to emphasize. This does affect you somehow. Now, with that in mind, let's say that over the long term, you are a dollar bear. You believe that the U.S. dollar is going to go lower throughout the long term in this country. And when I say long term, what I'm making reference to is, say, 10 to 15 years. You are definitely a U.S. dollar bear. You think that maybe we're printing too much currency in this marketplace. We are, let's say, you're thinking that maybe the stimulus money is going to hurt our currency. All the actions that the Fed's taking is going to hurt our currency. That's for you to decide. And it's not, it's for you to decide. And, I have my opinions with which I share with my clients, and I can talk a little bit more about my opinions at the end. But what I want to emphasize right now is just a way with which you can use these currency options in case you are a dollar bear through the long haul. Now, let's say you're a dollar bull through the long haul. Just reverse everything I say. Use calls instead of puts. Use puts instead of calls throughout the whole thing. So With that being said, you're a U.S. dollar bear. Fixed income in the United States would not benefit you on that sentiment. Just like what we talked about earlier in that 1% money market account, so to speak, you might be making U.S. dollars, but if U.S. dollars are being lowered in value, you're really not going to be that much better off. So if you're a dollar bear buying bonds or fixed income that's U.S. based, it's not going to be matching your sentiment. So with that, I mean, I'm not saying don't put anything into a savings account or anything like that. I think that would be silly. But if you're looking at fixed income as an investment and you're a U.S. dollar bear, then that's a direct contradiction with what you're looking to do. Now, the next thought is that, well, the U.S. stock markets. After all, a lot of times you can see maybe some inverse correlations between the euro and the U.S. stock market, or perhaps maybe if the dollar's weakening, that's going to encourage more foreign investors to buy U.S. stocks. And you know what? That might be true. The U.S. stock markets might help. And you know, I am long-term bullish on the U.S. stock market. With that being said, though, I know that Steve and I have pointed out on some past webinars that we've done on here, just because you're getting this great rate of return in the U.S. stock market, if you are a foreign investor investing in the U.S. stock market, it wouldn't be quite as great because of the fact that the dollar has gone down. And, you know, that's true sometimes, it's not true other times. It just kind of depends on which market and how you're looking at it. But my point is just like it affects the fixed income, just like it affects the goods that you're buying or selling as a business, it also can have an effect on the U.S. stock market. Well, the next question that comes up, if you're a dollar bear, why not invest in foreign stocks? Or what about foreign bonds? Well, let's investigate that a little bit. First off, foreign stocks. I am a fan of investing in foreign stocks. Now, what's in parentheses right there, I think is probably without a doubt the most important point of this slide, if proper risk management is used. Now, what is proper risk management? I've been talking about this for years, and I know Steve's been talking about this for years, but I'll give you kind of a Cliff Note version of what we believe proper risk management is. Risk with which you feel comfortable with if everything you're doing goes absolutely wrong. So how can you get risk management? Well, perhaps you can do buy a stock and then maybe put a collar on it. Or perhaps you can buy a stock and with a small enough section of your overall investment portfolio to where even if the stock turns out to be a dog, then you know what? It's just a small enough section of my portfolio. I'm okay without having any stop losses or puts in place or that type of thing. Diversification is good so long as it's real diversification and it's done in the right way. So there's a lot of ways with which you can use risk management. Just blindly buying stocks on the have a hunch, bet a bunch, sell the preem, live the dream, and kind of dealing and living in those areas, I think that's foolish, and I'm sad to say I've seen a lot of people lose money when not using proper risk management. Now, one of the main reasons that I like foreign stocks as a potential long-term investment is the fact that they can trade as ADRs in the U.S. It's a depository receipt. So if you were to buy a foreign stock, you're actually buying a depository receipt on a United States exchange. So with that, they're monitoring the trading of it in the U.S. And so does that mean the stock's never going to go down in value? No. Stocks can go up and down just like anything, but the fact that you have the ability to trade a stock from overseas on a U.S. exchange, I think is a good thing. So if you're a dollar bear and you're a long-term stock market bull, this is another choice with which you have as something to consider. I know that one thing that we're doing with clients right now, we have some collar strategies going on some various foreign stocks, and so we're doing several things on it, and this is something with which we're definitely using for certain clients that meet the proper criteria.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.